Welcome, everyone. This is our first weekly live segment. We're going to title it This Week in Options Trading with Eric and Brian. And we plan on going live every Monday at noon for the foreseeable future. As long as you guys are interested in showing up, we'll keep showing up as well. And we're basically just going to cover, some of our strategies, some different things that come up in the community about questions that may be better answered in this type of format. We're going to share some of the trade setups that we're looking at for the week ahead. And, probably be an hour at the most. I want to drag anything out. We probably get a better efficiency going after we do this a couple of times. So again, this is the first one. Again, we've got some more people coming in here. And if you're watching this later, if you want to join us live, because this is going to be recorded and posted on YouTube later, the best way to get the links is to go to stockmarketoptionstrading.net. And there is an events page. So it's stockmarketoptionstrading.net/events, and you'll see it here. If you create a free account, you can RSVP and it should send you reminders. And that way, you don't forget that type of thing. So that resource is there. And then if you have to leave early or can't make it next week, these will be posted on the Stock Market Options Trading YouTube channel. And we'll be sure to share those links as well. Now, before we get started, don't forget that everything in the session, on the channels, on the podcast, is not financial advice. This is for educational, informational purposes only. Brian and I will be sharing what we trade. Obviously, options are a little bit tricky and not for everyone. So be sure to do your own due diligence and that type of thing. So let's see if we have anybody else joining. Brian, welcome to the show. Thanks for agreeing to co-host with me. How are you doing today? How was your weekend?
It's good. Yeah, it's good. Nice hot winter park summer weather, huh?
It's brutal. It's really brutal here in
It is.
Florida right now. I know it's hot everywhere, but it's especially brutal this week. I've been having to go out a little bit earlier. I take the dogs for a walk in the morning, and usually I would go out around 10 or 11, but now, if I can get out at 9 or earlier, that's even better. Kids are back in school, so I have more time in the morning. And so I'm trying to get everything done a little bit earlier in the day. So, in case you didn't know, we have a couple groups that are merging here. We have the alpha crunching community, the stock market options trading community, and then Brian runs the local meetup options group in our city, Orlando, Winter Park, Orlando, Florida. And we typically do a meeting once per month, and we were doing it in person. Brian's been running this for 7, 8 years now. And when COVID hit, we kind of went online and we're trying to get it back to be more consistent now. Brian's been doing a good job. And so we had an in-person meeting last week. So I thought I would kind of kick off today's session with sort of a question or topic that came up in the live meetup, the in-person meetup, and then we'll open it up to questions and get into what we're actually looking at this week. So that's the goal that we're going to kind of start with. So I think everyone has joined by now. I'm not seeing any more. So the thing that came up last week was a trade. It was an alpha crunching trade that we put on each week. And for those who aren't unaware of alpha crunching, it's a kind of an analytics website that I run, some unique analytics, and then I find various strategies that we can trade in a mechanical way. We try to reduce the chart watching as much as possible and really try to have a little bit more of a statistical or mathematical approach to our trading. And one of those trades is a Monday 7-day to expiration put credit spread. So that's kind of this little shorthand we use. It's a WTR 70TE PCS. And this trade is valid for Monday this week. And just a real quick rundown is when you click on this, it tells you the parameters. And the first parameter is we want the Monday WTR to be 50% or higher. What is the WTR? It's the weekly triumph rate. And for this week, the WTR for Monday is 78%. So it's above 50%. Therefore, this trade idea is going to be on the board this week. The WTR simply shows the percentage of times the market closes higher 7 days later, weekly triumph rate. That's kind of where the name came from. Actually, ChatGPT named that when I was trying to name some of these things. I needed help. But essentially, over the last couple of months,
One
Monday
more
has
thing.
closed
Do
higher.
you by chance
7 days later, oh, hold on, I'm going to mute
a
all real quick.
windscreen?
There we go. So over the past couple months, Monday has closed higher 1 week later, 78% of the time. So we're definitely in sort of a bullish period. Obviously, the market's kind of maybe sideways pulling back here. And we can see the historical table of, how often the market closes higher 1 week later. And I have that for each days of the week. Earlier in the year, this was below 50%. So this trade would not show up. But that's how that trade gets on the board. And then let me go back to this. Here we go. And then the second thing is now that the trade's on the board, now we're looking to enter this trade on Monday. That's today at 3:30 p.m. Eastern, which is about 30 minutes before the close, but only if the 5-day moving average is above the 10-day moving average on the daily chart. So we're looking at some past historical sort of statistics or percentages, but we want to make sure that the current trend is also up. And what the WTR really is going to do is help you stay out of bear markets, which we're not anywhere near one right now. But this is pretty helpful to just have this list of trades this week. If we take a quick look at today's chart, we're kind of starting some consolidation here, but the 5-day moving average is still above the 10-day moving average. Therefore, later today, I'm going to be entering this trade. And the discussion part that we got into last week was really about the management of it and the strike selection. And what I want to kind of just quickly go through is the back test that we kind of landed on that was the best performer consistently was more of an at the money spread, and holding to expiration was really the best performer. Now I know Brian, you've watched a lot of Tasty Trade videos, and I know they often take the stance of taking profits early, but they also are trading farther out in duration, and they're
Right.
trading and they're trying to avoid that short-term risk, like 45 days. And well, do you remember any other Tasty Trade elements?
They also, well, they normally try to go out 45 days, close it at 21. I don't know if they use like that, 100% stop loss or not, but they usually
Yeah,
exit at 21, so that kind of takes care of that. But yeah, and I
right.
think like you said, the 7 day is really short, so it's hard to take. And you ran the back test in the meetup group, and it really showed that didn't really help in terms of
Yeah,
the
yeah. That's
profits.
what I wanted to do here as well, was kind of show the setup. And for those that are new, um, this is option Omega. I affiliate with them. We work together, but it's not my software, it's their software. And it's really great. I used to backtest this stuff on my own with data, and we had another guy that was helping us with it, and it's just so much data, but they do a great job and make it easy to backtest. And now you can actually automate the strategies, which is something we also talked about last week. But so I wanted to just kind of show the updated backtest. So one of the things I've been doing now that we're into August now, but is I like to update the backtest with the latest data to see, is this strategy still working? Should we stop trading it? Is there anything, or maybe make adjustments? And I landed basically on the same thing. I've been trading this with the automation, which has been going well. So I'm looking to do more of that. But basically, when the trade entry comes, and again, these results are January 1st, 2023 through August 1st, earlier this month, 2025. And we're trading an at the money spread where we sell a put around Delta 48. That's, let's, loosely Delta 50, which is kind of right at the money. And we buy a put 5 points later or lower, excuse me, with 7 days to expiration. Again, here we have the trade time. And this particular backtest allocates 2% of the portfolio per trade. And we want to make sure that 5 day is above the SMA. Now, this particular backtest holds it to expiration. And over the last 2.5 or so years, this Monday trade has a 77% win rate. And the key thing that I like to hone in on is the risk reward. We're risking $300 basically to make $200. So we want a minimum premium of $2 on this spread. And that kind of helps keep our risk reward in check. So we're not just, and for this strategy, we're not just trading options and probabilities. We're using, for the lack of a better term, some super basic technical analysis to say, hey, are there, are we in some bullish conditions? Yes. Well, let's be aggressive and trade at the money spreads. And when the losing trade comes, we're not going to get wiped out. We're not going to wipe out 10 winners with one loser. We're going to basically wipe out 1.5 winners with one loser. So that's kind of the general idea. And so this is the hold to expiration version. So what I wanted to show, and this is sort of the focus of this episode, is taking profits at 50%. So if I add the 50% profit target here to the back test, and I'm going to put their recommended settings for profit taking where we required 2 hits, and we want to cap the profits that are in non-opening. That way we don't get any irregular wins or losses. And we're going to kind of let this run and see the results. So again, we had a 77% win rate. The average per trade was $94 per trade. So for every $300 risk, you made 94, and we had a 3-to-2 risk reward. So here are the results, taking profits at 50%. And the first thing is, obviously, we're still risking 300, but with taking profits at 50%, we're going to reduce our average winner because we can't get the whole credit of or the max gain, which would be about $2. And that's going to drastically reduce our return on risk. So instead of $94 for every 300 risks, we're only making $27 per risk. Now, however, we did raise our win rate by just a little bit. So, but obviously we made less money and the numbers aren't as great. One thing I forgot to show you, and let me just bring up this one real quick. Again, this might be automated WTR, the Monday one. One thing I didn't share was the P&L curve. So this is holding to expiration, the original one. And you can see that when there is a losing streak, yes, you give back some of your gains, but the winning streak, because the winners are still pretty decent in size, they are going to, propel you to new profit or new profit highs, if you will. If we look at this one, this is the difference in the risk reward. So now that the reward is only, let's call it $100, and the risk is still 300, that losing streak really pulls you down. And even though you had a nice win streak, you need a lot more winners to make up for it. So this P&L curve is a little bit more volatile, despite the slightly higher win rate of almost 80% for an at the money spread, which is still pretty good compared to the hold to expiration version, where you can absorb those losers a little bit more easily because they're not as big compared to the profits in size. So I'm going to pause there and see if you guys have any questions about that particular comparison, about taking profits or holding. So let me know in the chat if you have any questions. I'm gonna double check, make sure we let everyone in here. Looks like everyone's in. All right, I'm not seeing any questions so far. So yeah, I'm looking. Oh,
what does 2% risk mean?
Okay, good question. So 2% risk of a 100K account means that what the software is going to do is calculate what's the max loss of the trade. And this might be best. Let me come in here, ascending. So the very first trade, when it had the $100,000 account, it took the first trade in January of 2023. It ended up taking 7 contracts. So what it's looking at is, what is the max loss? So if it got a credit of 225, the max loss is going to be 275. So it's going to try to keep that under the max loss to 2% of your risk. That's the goal. And I'd have to do the math to verify that. But the idea as the account grows, you're still risking 2%, but the number of contracts may grow. See how it goes back and forth between 6 and 7. As the account grows, now it's taking 8 contracts. But if once we take this loss, that loss should be under 2% of the account. And, not everyone has a $100,000 account. We could run this again, trading 1 contract at a time and a 5,000 account. So this is something that, Option Omega is good for. You can kind of look at your account size or your risk tolerance and, sort of adjust it to what you're comfortable with. The drawdown here was 8%. So what that means to me, there was probably 4 losers in a row where you lost 2%, lost 2%, lost 2%, lost 2%. But that 2% risk yielded an average of 12% per year, with the rest of the money being in cash essentially. So that's what 2% of the portfolio means. So someone says, can we try 75%? Yes. Would incorporating a stop loss and taking profit at 50% make sense? Well, we tested the 50% profit take, and that did not help and made it extremely worse. The thing about the stop loss, because we're trading at the money spreads, I consider this risk reward to be the same. If you put the stop loss in, and we can do it, I'll run the stop loss, but you have to think about what the stop loss is. So if you're risking 300, the stop loss is going to be based on the profit. So in this case, 200. So if we're willing to risk 100 and the profit taking is
You see this.
and the profit taking is, I'm sorry, let me repeat that. The credit for these trades for a 3 to 2 risk reward is going to be about $200. So a 50% stop loss means you're going to risk $100 because the max loss is 300. So we could risk 50%. If we risk a 100%, we'd be risking $200, right? We can go ahead and run that. We need to turn the stop loss, and let me just run that and see what it is. So the question I would pose to the group is, the person asked about the stop loss is how much are you actually willing to risk? Like you probably need like a number. So the stop loss, it helped a little bit compared to the profit taking. We reduced the losers a little bit, but you're also reducing your win rate, and you're reducing the P&L, and you're reducing the average per trade. So doesn't mean you can't do it. It still made money every year so far, but the 3 to 2 risk reward is now this is closer to 1 to 1, but the 3 to 2 risk reward is, to me, it's acceptable. And I just risked the $300. It also makes it easier to manage. So in OO, do you send the link to your backtest setups? Yes, I am putting together an alpha crunching Discord server, and I do share the backtest and we'll post those there. So I'm trying to think about how to get that to you now. But I do share those. And if you're in the alpha crunching community or in the stock market option trading community, we can share links, or you can message me about that. Let me go back to this one. I can share this one right into the chat. Let me do that now. So for those that are Option Omega users, do this group chat. There we go. For those that are Option Omega users, the specific dates in the backtest are going to tell you which days the WTR criteria was met, and then it'll look at the moving averages. All right, you're welcome for running the numbers. All right, so again, that's a trade that I'm looking to put on this afternoon. I have this automated, so it will enter on its own, and then I like to check to make sure it gets, the right strikes and everything. So Brian, do you have any comments or anything you want to add to this before we move on and you can share what you're doing?
Yeah, I mean, no, I like that strategy, mainly because, like you said, you could just set it and forget it pretty much, right? Because it's a
Yeah.
7-day trade. And I think what I've learned is if you watch it too closely, then you end up getting nervous and jumping out and taking profits earlier. And if you just wait, for the trade, trust the numbers. It's a cash settled trade, so you can't be assigned shares. It's, tax benefits of
Yeah.
using SPX. So I think it's a great trade. I thought it was a great meetup last week, and so
Great.
I thought it was a fun day, and that's a great little trade.
Awesome. All right. Well, I know you've been busy this morning. I'm seeing you closing a few trades and opening a few trades. So I'm going to hand the presenting over to you, and I'm going to stop sharing and make you presenter so you can talk a little bit about what you are looking at this week.
Sure. So, like Eric said, he and I do different strategies. I do a lot of the SPX trades that Eric puts on, but I started kind of doing a lot of what I call the conservative cover calls, buying the shares, selling the in the money strike, mainly as an income. I still do that mainly to capture dividends, but one of the strategies that I seem to be doing a lot of lately is a diagonal call. It's also known as the poor man's covered call. So, and really all that is is we're using a longer dated call to basically enable us to sell calls against it. So this morning, let me just find the one I closed out. So on STX, I put that trade on.
Hey, Brian, are you able to share your screen?
Yeah, I'm gonna do it right now.
Okay. I want to make sure I gave you the right permissions
I
to
think, well,
do
let me
that.
look. I'm gonna send you a request.
Yep.
Okay. So this is right from the Alpha Trading Club. So this is the trade we closed. I just put the closed out. So we closed this trade and for a credit of $10.25. And the basis in the trade was $7.89. So it was a 29.9% return in 7 days. And so that was one we just closed. This is one here that I just put on. And I can walk through it with you guys just to show you kind of the basis for this trade. So, first of all, ANET, I put the trade on this morning. The stock itself was trading for 136.45 a share. So what I did is I went out to September 19th and I bought the 135 call. And at the same time, I sold the 829 call, or I'm sorry, 829 142. So the net on it was $5.80 per contract. So I bought the 135 calls for $7.42. Now, if I had gone out and bought 100 shares of ANET, it would have cost me like $13,000. So I bought two of them personally. And so I have more than, 100 controls of 100 shares for, a fraction of the cost of if I went and bought the shares. And then I sold the 142 call and collected a credit of 162. So my net cost in the trade is $5.80. And I did some quick math. So if the stock goes from 136.45 to 142, that would be about a $5.5 move, $5.50. And since we have the 55 delta, we would capture about $3 growth in our long calls. So that would be like a $3 return on our $7.42 call. So that's kind of the beauty of the call of this strategy. It's cost effective. It still costs us, $580 per contract. But, if it got to exactly 142 by next Friday, that call would be worth probably around $10. And so that'd be a nice return on the trade. So that's why I like the trade, and I'd be happy to try to answer any questions anybody has.
So the poor man's covered call, and so you're still bullish on the stock though, right? Like,
Still right, still bullish on the stock. And I sell the call kind of where the expected move is going to be. So if the stock moves from 136 up to 142, it'd be about a 5.5 point move.
yeah.
And if you were, less bullish, you could get a little closer to the money. But one of the problems there is if it goes through your strike, then you start losing on your short call. So I always try to be a little conservative in what I sell out there that far.
Okay. One question in the chat is, and of course this is always the question is what if it doesn't go up? What if it goes down? What's
Yeah.
your kind of exit plan for this
Yep.
trade if it doesn't go right?
Right. So if the stock drops from where we bought it at 136, I would exit if the stock dropped 8%. So I think it was like 125.50. So if the
Do you have a
price
chart of the stock to maybe kind of give us a reference of the levels? Because I don't really follow ANET, but maybe it would be helpful to kind of get an idea of the chart.
Sure. Let me
So Tim,
unshare.
while you're doing that, Tim is asking, ANET is a CDS called debit spread. So Tim, no, ANET that he's trading is he's called
It's Arista, I think is the name of the stock.
Yeah. He's not doing a call debit spread. It's a it's basically a diagonal spread, but they also call it a poor man's covered call.
Hmm.
And where you're buying a call, sort of like instead of buying the stock, you buy a longer dated call option. So that's sort of your 100 shares. And then you're able to sell a call against it, like a covered call. So you're covered with an option as opposed to the shares. Um,
Yeah.
so that's that trade. So, okay, here's
Okay,
the
so here's the
chart.
chart, and you can see it, it popped up after earnings and it's kind of basing, but the 142.50 would be right around, the high. So, it's kind of a nice target area to get to. And so that's why I picked it. I do a watch list every weekend with, covered calls, butterflies, and the poor man covered call or the diagonal. So this one, is the chart of it here would be, if it got up to here, it would be a perfect trade in terms of kind of the maximum reward. Now, the other thing I would say is if it didn't get to 142.50, we could always roll that call out another week and collect additional credit. So every time we roll the trade, we're collecting additional credit and it reduces the basis, our basis in the trade, just like a covered call. But instead of reducing it based on the $136 a share, it reduces it, based on, I guess $5 a share, seven, whatever it was, what we bought it at. So you're reducing your basis in the trade significantly every time you sell a call.
Interesting.
So that's kind of the poor man covered call. And the good thing is, you can scale up, you can do one trade. And so, if somebody didn't want to trade, 13,000 on one particular trade, this trade, cost you, I guess, $5 or something like that. So $5.80 is what it cost me. And I usually like to sell the first call 2 weeks out to give it plenty of time to kind of run up to that level.
Right. Gotcha.
So that's the diagonal call, and also known as the poor man's covered call. But and what I'm trying to look for is a good stock in a bullish trend that offers weekly options and has great liquidity and doesn't have earnings kind of popping up, right
Yeah.
into, because what you don't want to do is hold this through earnings. You want to get out before earnings.
Yeah. Yeah. So, I think we got our, oh, someone says, can you talk more or show us how you would roll the call?
Sure, sure. So if we got closer to August 29th and we wanted to roll that call, all we would end up doing is you could either do it one of two ways. You could roll it out to, actually, you want me to show my screen?
Yeah, I think we see your screen now, the chart.
I was gonna show the my actual. So if we were gonna roll this trade out, you would actually just roll it out to 9.5. And then I could use the same, expiration or roll it up. So if I just rolled it now, which we wouldn't do, it would roll it for an additional 80-cent credit. My rules are I want to hold this trade until I at least collect 80% of the credit in that short call before I would roll it. And a lot of times it might get really close to that, 142 by next week. And I really want to hold it as long as I can so that I can exit the trade for that 30% profit. That's my goal in these trades, is to hit 30%. And we do that pretty regularly if we pick the right stock and it moves in the right way. So any other questions? Did I answer your question about rolling? And I just want to make the other way you could do it is just close the trade out and then sell a new call. So that's it accomplishes the same thing. Either way you do it. Eric, you're muted.
Oh, thank you. Good stuff. We got a question about back on the SPX trade about they wanted to see the profits for 75%. And we can run that here at the end. I think that was, where'd it go? Yeah, Mark. Yeah, Mark, we'll run that here in a minute. Before we get to that though, I do want to point out a couple bigger events this week. So I'm going to take over the sharing
Yep.
here, Brian.
Okay.
I
All
just want to
yours.
Yeah, I just wanted to, can you see my screen? Yeah, you see my screen. One of the things I like to check each week is the economic calendar. I don't really take trades because of the calendar, but what I sometimes will do is adjust maybe some entries or my profit taking, for example. So this week's kind of a big one. We have FOMC on Wednesday, the 20th. We all know how that can go. I don't see a Powell press conference that day, but we will get some light on interest rates. Obviously, the market would prefer interest rates to go down. But then the bigger, probably bigger event, and this has been, I think this was bigger back in 2008, was the Jackson Hole Symposium, where all the economic bigwigs get together in Jackson Hole, and Powell is speaking on that day. And I think historically, that Jackson Hole Symposium, I think that's when Bernanke came out and announced they were going to start doing quantitative easing, and that marked the maybe the bottom of the 2008 financial crisis. So people still tout this as like a really big deal. I don't think it's going to be a bigger deal than what a normal Powell speech would be. I don't think there's any magic here, but it is on the calendar and something to look at. I really don't plan on doing anything different, but once we'll see, as my automated trades come into play, if I feel like I have too much risk on, I may simply close one early or just maybe not open a new one. Have a couple call credit spreads on the docket this week too. So I'm going to see what it looks like later. But if we're in both a mix of put credit spreads and call credit spreads, I'm probably just going to let it ride and go with the strategy there. So one person want me to run. This is the see, make sure I'm on the right one. This one is stop loss. So let's keep running this one. We're going to do, he wanted to run the 75% profit target. I'm going to take the stop loss off and require 2 hits. Let's run this at 75%. So remember, holding to expiration, we had a 77% win rate. Average per trade was 94. So can you live with 77%? If you can, that's better off than the 79% we saw earlier. So let's see what it looks like with 75%. So we still had a 77% win rate, but we basically left money on the table by closing early. So it really didn't help with the 75%. And I think this is the nature of the at the money options. And that's what I've kind of found. When you sell out of the money, like let's say Delta 30, Delta 20, I think the theta is greater as a percentage. At the money options aren't going to decay as much. So we're really betting, this trade is really betting on the market closing higher for whatever that duration is. And if it closes higher, you get to keep everything. If it closes lower, you lose everything. But again, that ratio is 3-2. With the 75%, it's more of 2-1, I guess, something in there. So. All right, let's check the chat before we go. Brian, there's someone asking, would it be beneficial to use an out of the money SPX poor man's covered call with a 3-month duration? I don't think that's FOMC decision. Yes, that's right. They're
just the minutes.
Yeah, just the minutes. You're right, Jackie.
But what's in those minutes can sometimes, stir up the market. So that's why a lot of people. But the other question about the using SPX, it's really the same strategy. It's it's a bigger trade, but yeah, you could do, and I've actually done it on using SPX. So if you had a longer, you just wanted to do the same concept but do it on SPX, you certainly could.
Yeah, I think for me, what I've been using more as a crutch to understand some trades, I've been using the risk graph or risk profile more. And so for me to like what I would want to do to answer Hitech's question is, if you have Tasty Trade or Thinkorswim or Option Strat or one of these platforms, you can put that trade in there and you can see, okay, well, what's my max loss? What happens if it goes up? What happens if it goes down? And kind of get an idea of what that trade's going to feel like. And then you can decide if you want to kind of trade that. So that's what I would recommend if you're new to a strategy like that, is really kind of understand where the risk is.
Yeah, and if I was new to it, I would start with SPY instead of SPX just to get a feel for it. But it's basically a synthetic covered call to a great degree.
Right. Right. All right. El Belvin's asking, most of your trades are 7 day. He's talking about the SPX trades that I shared. If we miss the 3:30 to 4 p.m. window on Monday, I'm assuming, how would a next day 6 day to expiration be if the entry criteria was still met? So it's a good question. I think that's Larry. With alpha crunching, for example, with that particular trade, there's a 7 day on Monday, and there's also already a 7 day PCS on Tuesday. So if you miss the Monday one, in this case, you would have a Tuesday one. I think it's really going to depend on what the market does. So if the market gaps up, let's say you missed the trade on Monday, and then on Tuesday the market gaps up, the Monday trade's going to be in profit. So you would essentially be chasing that. If you were to say open it Monday morning, you'd be chasing the gap up, and you would have a, quote unquote worse position. Your strikes would be higher, and you would not have the same, it wouldn't be the same trade essentially. If the market gapped lower and you sold something lower, your probability is going to maybe be better than the original entry. So it's really going to depend on what the entry is. But as you can see, there's several trades here, and there's already a Tuesday trade. So for some reason you couldn't get to it Monday. Now keep in mind, these SPX options trade until 4:15. So you actually can get in at 4:15 if you miss it by a couple minutes. So you could still get in. But yeah, if you missed the entire afternoon, then it's really going to depend. If you can get in for a similar price as yesterday's, I mean, you would have to know what that is. Then yeah, you could take the trade the next day. You know, I wouldn't want to take a trade after the market's moved a certain percent, because this particular trade is based on Monday's close. So if you miss Monday's close, you're kind of just at the mercy of what the market does the next day. Is Discord the place to interact moving forward? Do Alpha Crunching subscribers have a chat? I am working on the Discord server for Alpha Crunching specifically. That this group is more the stock market options trading group and podcast. So we have two kind of groups that work together. But I am working on an Alpha Crunching Discord server, and yes, you can have a chat to ask questions and whatnot. I can actually bring that up. And one of the things that we can talk about maybe next week is on the Alpha Crunching Discord server, I've incorporated, or I've not incorporated, I've added the unusual whales options bot. So you can come into the Discord server and issue commands to get live options flow. And this will be free to anyone who joins the server. You don't need an Alpha Crunching subscription. This is outside the scope of today's discussion, but I am working on building this out. And if you're already on my email list or in your groups, I'll be posting more about it to get you over to Discord. It's going to allow for some additional automation, and they have things like this, the more tools that we can use. It's more of a bot friendly platform. Awesome. All right. I know we're jumping around all over the place today, but appreciate everyone coming out. Anything else before we go, Brian?
No, I mean, the only other thing, you still have all that Ukraine, Russia stuff. That could definitely be a market mover in addition to economic reports. I think that's probably one reason the market's a little skittish looking today. But
Yeah.
a lot of big kind of world news that's impacting the market more lately than, we had all the tariff stuff that seems to mostly have been passed by, but seems like more and more, news events coming in that can change the market. So just be aware of, that's another kind of impact on the overall market.
Yeah, I know I said earlier that the market wants the Fed to cut rates. And so I think it was this weekend, I went into Chat GPT, and again, disclaimer, I don't know if this is everything's valid here, but I wanted to get an idea of how the market reacts with the first rate cuts. And we've already had the first rate cuts last year, which has kind of sparked the rally we've seen. But there's actually a lot of negativity around the rate cuts, because if the Fed waits too long, then that means that the economy is struggling. And when they do that first rate cut, if they're doing it because they have to or because they're late to the party, that can actually be a short-term sell signal. So this is a unique, all these situations are unique, and there's probably not a big enough sample size for it, but I think we're unique here in this situation because they've already had a rate cut And now we're just waiting on the next rate cut. So I don't think it's going to be as impactful. But if they don't cut soon enough and jobs start to go, I mean, the job numbers have been pretty good, but inflation's kind of hit or miss month over month. I think they could probably cut and everything, be normal. But anyway, just that was an interesting thing I kind of discovered, was that rate cuts aren't always good, because that could mean there's bad things happening. So yeah. All right. Well, you guys, thanks for joining live. I'm going to get this posted if you want to watch the replay. And again, check out the stockmarketoptionstrading.net/events if you want to RSVP, and we'll get those posted. Thanks, everybody.
Thanks, everybody.
Thanks, Brian.
Take care.
All right. Talk to you soon.